36% yield on an AI-powered ETF. That headline stops the scroll every time. But before you picture easy money rolling in from the hottest names in tech, let's be clear. This fund is not printing cash out of thin air. It is running a specific options machine on top of a concentrated basket of artificial intelligence stocks, and the way that machine works shapes everything from the payout you receive to the value of the shares you hold. Today we are going to open the hood on the REX AI Equity Premium Income ETF, ticker AIPI, and see exactly how it turns AI leadership into weekly cash. AIPI launched on June 4, 2024 from issuer REX shares. It is an actively managed exchange-traded fund that sits in the derivative income category and holds equity in leading artificial intelligence companies. The fund selects its positions from the holdings of the Beta AI Leader Select Index, giving it a focused but flexible way to stay inside the AI theme while still reacting to market conditions. What makes it different from a plain AI stock fund is the income layer it adds on top. It writes covered call options against the stocks it owns. That options overlay is the engine that produces the large cash distributions investors see each week. The expense ratio is 0.65%, and the fund pays distributions weekly. On the surface, it looks like a high-octane way to own AI with income attached, but the real story lies in how those calls are struck, how much upside gets handed away, and what happens to the net asset value when the underlying stocks move. This video is for educational and informational purposes only. It is not financial advice, investment advice, tax advice, or legal advice. It is not a recommendation to buy, sell, or hold any security. Exchange-traded funds can lose value, and past performance does not guarantee future results. High distribution yields can include return of capital, which reduces the fund's net asset value over time. Always read the current prospectus, fact sheet, and holdings reports directly from the issuer, and consult a qualified financial professional before making any investment decisions. The information here reflects data as of July 7, 2026. Right now, the net asset value and share price both sit at $36.37. Assets under management total $415 million, which tells you this is a meaningful but not gigantic fund that has gathered real investor interest since launch. The expense ratio of 0.65% is typical for an actively managed options income product, but it still eats into returns every year. So it matters when you are comparing it to lower-cost index funds. Because it pays weekly, the cash arrives more frequently than most monthly payers, which can feel convenient for income planning. The fund is built entirely in equities with a derivative income wrapper, so its fate is tied directly to how the AI names it owns perform and how the covered call strategy behaves in different market regimes. The headline distribution yield stands at 36%, and the mechanical annualized yield calculated from the most recent payment also lands at 36%. The latest distribution was 25 cents per share. To put that in context, the average of the first 4 distributions since launch was 147 cents, while the average of the most recent 4 distributions is 25 cents. That yield figure is eye-catching because it annualizes the current payout rate, but the actual cash you receive each week depends on how the options overlay performs, and on any capital the fund may return to keep the distribution steady. A 36% yield is only sustainable if the underlying strategy keeps harvesting enough premium without too much drag from falling stock prices or from the calls capping upside. When the yield stays this high for long periods, it usually signals that part of the payout is coming from sources other than pure option premium. The distribution trend tells a clear story of compression. Early payouts after launch were dramatically larger, with that first 4 average of 147 cents reflecting the higher premiums available when the fund first started selling calls into a strong AI market. Over time, those payouts have settled down to the current 25-cent level. The drop is not random. As the net asset value moved lower and as volatility and option premiums adjusted, the amount the strategy could reliably harvest each week changed. Weekly payers like this one have to keep the distribution flowing even when market conditions tighten, which sometimes means the fund has to adjust the call strikes, reduce coverage, or tap other sources to maintain the schedule. Watching whether the next several distributions stay near 25 cents or continue to drift gives you a real-time read on how well the income engine is running. The net asset value path since launch has been punishing. The fund began with a reference price of $52.38, and the current net asset value of $36.37 represents a 31% decline in NAV since inception. That is before you even factor in the distributions that have been paid out. The maximum drawdown reached negative 42% at one point, showing how quickly the AI-heavy basket can fall when sentiment turns. Because the strategy sells calls, it collects premium that can cushion small declines, but it does not protect against large drops in the underlying stocks. When the net asset value erodes, future distributions are calculated against a smaller asset base, which can create a feedback loop where the same percentage yield requires either higher option income or a return of capital. The 31% NAV decline is the clearest signal that the high yield has come with a real cost to the principal value of the fund. If you add every cash distribution back in, the simple distribution-inclusive return since inception is 26%. That number is worth pausing on because it shows the fund has delivered positive total performance once the payouts are counted, even though the net asset value itself is down 31%. The 26% figure captures the reality that investors who reinvested or simply received the cash have seen their overall position improve relative to the starting reference price. It also highlights the core trade-off baked into covered call income funds. You are giving up some of the upside in strong rallies in exchange for more frequent cash. The inclusive return being positive, while the raw NAV is deeply negative, tells you the distributions have more than offset the price decline so far. But it also means the sustainability of that offset depends entirely on whether the options strategy can keep generating enough premium without further NAV erosion. Here is exactly how the machine works. AIPI owns a concentrated basket of leading artificial intelligence stocks and then sells covered call options against those positions to generate premium income. The top holdings are CrowdStrike Holdings at 9, 88% Palantir Technologies at 9, 63% NVIDIA at 9, 59% Astra Labs at 6, 97% ARM Holdings at 5, 70% and Palo Alto Networks at 3, 87%. These are the actual names the fund trades around. Because it is actively managed, the manager can adjust weights inside the beta AI leaders select index universe as conditions change. The income comes from writing calls that give someone else the right to buy those shares at a set strike price by a certain date. In exchange, the fund collects the option premium upfront. That premium is what powers the large weekly distributions. The trade-off is straightforward. If any of those stocks surge past the strike, the fund caps its upside and may have to sell the shares or roll the calls, limiting how much it participates in big AI rallies. In sideways or mildly down markets, the premium can provide a buffer, but in sharp sell-offs, the calls offer little protection and the net asset value can still drop hard. High payouts can also include return of capital when option income alone is not enough, which reduces the fund's asset base and can make future distributions harder to sustain. It is the classic income now versus growth later bargain, executed on a high-volatility AI equity sleeve. Going forward, watch the level of each weekly distribution relative to the current 25-cent run rate. If it holds steady without increasing use of return of capital, that is a positive sign the options overlay is still harvesting sufficient premium. Track the net asset value path against the AI sector itself. If the basket of names keeps falling while distributions stay high, the erosion dynamic is still in play. Monitor implied volatility in the names the fund owns, because lower volatility tends to shrink option premiums and can pressure the yield. Keep an eye on how much of each distribution is classified as return of capital versus ordinary income or capital gains in the fund's tax reporting. Finally, compare the ongoing 0.65% expense ratio against the actual income generated. If the net payout after fees starts to compress, the economics of holding the fund change. AIPI delivers a striking weekly income stream by selling covered calls on a concentrated AI equity portfolio. And that strategy has produced a 36% headline yield and a positive 26% distribution-inclusive return since launch. At the same time, the net asset value has fallen 31% with a 42% peak drawdown, showing the real cost of the capped upside and the income over growth priority. For investors who want cash flow from the AI theme and are comfortable with volatility and potential principal erosion, the fund does exactly what its structure promises. For anyone whose main goal is long-term capital appreciation in artificial intelligence leaders, the same structure that creates the high yield also limits participation in the biggest upside moves. The choice comes down to whether the weekly cash is worth the trade-offs the options machine imposes. Always verify the latest holdings, distribution composition, and prospectus before deciding what role, if any, this fund should play in your own portfolio. 2 quick things before you go. If this teardown helped you see past the headline yield, hit the like button. It genuinely helps the channel. Subscribe so the next ETF autopsy lands in your feed. And drop a comment. Which ticker should we put on the table next? And where do you think the real risk is hiding? We read everyone. Thanks for watching.